Hey everyone, and welcome. So have you ever pulled up a financial chart and just stared at it? You know, that crazy mess of jagged lines that looks more like a heart monitor than anything else? It can feel totally overwhelming. Well, what if you had a toolkit, a system, to make sense of all that chaos? That is exactly what we're going to build today, using John Murphy's legendary book, Technical Analysis of the Financial Markets, as our guide. Let's jump in.
Right off the bat, here's the multi-trillion-dollar question. How on earth do you find some kind of order in what looks like pure random noise? This is the central problem that technical analysis even tries to solve. And look, it's not about having some magic crystal ball. It's about building a framework so you can make smarter decisions based on what the market is actually telling you. Okay, before we go any further, we need to get one thing crystal clear. There are two main camps when it comes to analyzing markets. On one side, you've got your fundamental analysts. Think of them as detectives, digging through earnings reports, economic data, trying to figure out what a company should be worth. But on the other side, you have technical analysts, and that's our focus. They believe all those clues are already baked into the price. They study the what, the price and volume, not the why. So if we're going to build this toolkit, we've got to start with a solid foundation, right? John Murphy's entire system is built on three core beliefs. You have to really get these before you even look at a single chart. They are the bedrock of everything else we're going to talk about.
And here they are, the three pillars. First, market action discounts everything. This is a big one. It basically means that anything and everything that could possibly affect a price, from a news report to investor fear, is already reflected in its current price. Second, prices move in trends. The market isn't just a random jumble of ups and downs, it moves in identifiable directions. And third, and maybe most important, history tends to repeat itself. Why? Because human psychology, things like fear and greed, are constant, and that means the patterns they create on the charts tend to show up over and over and over again.
Okay, with that foundation in place, now we can start actually filling up our toolkit. Let's talk about the basic instruments. You can think of these as the essential gear you need to start visualizing and interpreting what the market is trying to tell you, to learn its language.
And the number one tool, the canvas for absolutely everything we do, is the chart itself. And I want you to notice that key phrase here. It's about what the market is doing, not what we think it should do. This is a huge mental shift. A technical analyst uses the chart to react to reality, not to force their own opinion on it. It's all about objectivity.
So the very first thing an analyst does when they look at a chart is ask a really simple question. Which way is this thing going? And according to Murphy, there are only three possible answers. Is it in an uptrend, making higher highs and higher lows? Or is it in a downtrend, with lower lows and lower highs? Or is it just stuck, moving sideways in a range? Figuring that out is job number one, always.
Now, once you see a trend, you start to notice these invisible floors and ceilings in the market. Support is the floor. It's a price level where buyers seem to always show up and say, nope, not going any lower, and prop the price up. Resistance is the ceiling. It's that price zone where sellers come out in force and stop the price from climbing any higher. Learning to spot these levels is just absolutely crucial for planning where to get in, where to get out, and how to manage your risk.
All right, let's build on that. Remember that third pillar, history repeats. Well, this is where that idea gets really, really practical. Because human behavior is predictable, certain shapes or patterns appear on charts again and again. Learning to spot these patterns can give you some serious clues about where the price might be headed next.
Now, Murphy basically groups all these patterns into two big families. First up, you have reversal patterns. Think of these like flashing red warning lights on your dashboard. They're telling you that the trend you're in is running out of gas and might be about to turn around completely. Then you have continuation patterns. These are more like a quick pit stop. They signal that the market is just taking a breather before continuing on in the same direction.
So a classic example of a reversal pattern is the famous head and shoulders. And yeah, it kind of looks like what it sounds like. Three peaks where the middle one, the head, is the highest. This pattern basically represents a final failed push higher. When an analyst sees this shape forming after a long run-up, that is a major red flag that the good times might be over.
And on the flip side, for continuation patterns, you have things like flags or triangles. These are usually small, tight little patterns that show up right after a really sharp, powerful move. They're basically the market catching its breath for a minute, a brief pause before the original trend is likely to take off again with even more force.
Okay, so patterns are really powerful, but let's be honest, they can be a little subjective, right? One person sees a pattern, another doesn't.
To add a layer of objectivity, we bring in the next set of tools in our kit, the advanced gadgets. These are basically mathematical indicators that help us quantify things like a trend's strength or its momentum.
Now, this is a huge point that Murphy makes. There's no single magic indicator that works all the time. It's all about using the right tool for the job. You wouldn't use a hammer to saw a piece of wood, right? Same idea here. If the market is trending strongly, you use trend-following tools, like moving averages, to help you ride that wave. But if the market is just chopping around sideways, you'd switch to something called an oscillator, like the RSI, to help you spot when it's getting overbought or oversold within that range.
This is the big one, folks. Price tells you what happened, but volume tells you the conviction behind the move. Think of it like this. A stock breaking to a new high on a massive surge in trading volume, that's a powerful, confident statement from the market. But that same stock breaking out on really light, weak volume? That's suspicious. It's much more likely to fail. Volume is your confirmation tool. It's the truth serum for price.
And all of this brings us to the final, and honestly, the most important part of our toolkit, building your master plan. See, the goal isn't to find one magic pattern or one perfect indicator. The real skill is in combining all of these different tools into a disciplined, logical system that actually works for you.
This slide really brings it all home. It's about using multiple tools to confirm what you're seeing so you don't act on a single flimsy signal. It's about having non-negotiable rules for when you get in a trade and, just as important, when you get out. It means always managing your risk. And here's the kicker. You have to accept that no system is perfect and you will have losing trades. In the end, the discipline to follow your rules is way more important than being a great predictor.
And we'll leave it with this powerful idea right from Murphy that just sums everything up perfectly. Technical analysis isn't about gazing into the future. It's about the craft of building a logical, rules-based system to manage probabilities and, most importantly, control your risk. So the real question isn't, can you predict the market? It's, can you build a system and have the discipline to navigate it?